All right, let's dive right into this explainer. Today, we're building a strategic scaling playbook. If you've ever wondered how top-tier entrepreneurs actually build those massive empires behind the scenes, well, you are absolutely in the right place. We're going to completely demystify business infrastructure, real estate wealth, and modern automation, using insights straight from the industry's heavy hitters. We're skipping the surface-level fluff and getting right into the exact operational levers that create real, lasting, generational wealth.
Here is our game plan for today. First, foundations of business success. Second, real estate tax advantages. Third, the 4 C's of lending. Fourth, comparing strategic loan options. And finally, number 5, scaling operations with AI. Let's get right into it. Kicking things off with Section 1, Foundations of Business Success, specifically focusing on operations over sales. Now, it's kind of crazy, but most people focus entirely on sales before they ever build their infrastructure. We get so caught up in the flashy, outward-facing stuff, like marketing and branding, that we completely neglect the back end.
So I want you to ask yourself this question to fundamentally shift your mindset. Do you go out and buy the absolute nicest, most expensive basketball first, or do you practice your shot? It sounds simple, right? But it hits the nail on the head. Practicing your shot, that's your operations. It's the gritty, unglamorous, behind-the-scenes work. Because look, if you have a beautiful basketball but you literally can't shoot, you're going to lose the game. Prioritizing that gritty back-end practice over flashy aesthetics is absolutely crucial to building a company that actually survives its first year.
And this brings us to the PROF framework, which brilliantly breaks down the exact mindset you need. Let's walk through it. P is for persistence, meaning you're pushing through no matter what challenges you start with. R stands for relevance. Can you genuinely relate to your consumers and banking partners? The first O is operations, the actual backbone we just talked about. The second O is omnipresence, basically using tools like social media so your target audience sees you everywhere. And finally, F is for fundings. Because whether you're in real estate, entertainment, or whatever else, knowing how to fund your operations is the whole shebang. It's what makes scaling possible.
Moving right along to Section 2, Real Estate Tax Advantages, also known as the Wealth Engine. Let's see how this operational mindset translates into the ultimate vehicle for wealth.
Get this. A staggering 50 to 60% of the entire world's income is generated through real estate. In the US alone, we are talking about a $3.7 trillion market. To put that into perspective with a real-world example from our sources, imagine buying a property in New Jersey for around $580,000, and over a relatively short period, watching it appreciate to $1.7 million. That right there, that appreciation is exactly why real estate is the foundational asset class for the top 1%.
But hey, making the wealth is only half the battle, right? Keeping it is the real trick. You can protect that money through strategies like the 1031 exchange. Think of it like a giant piggy bank you don't actually touch until you transfer it to a new property, which completely defers your capital gains taxes. Instead of taking a massive tax hit when you sell, you just roll those funds directly into the next investment. When you aren't losing 20 or 30% to taxes every time you sell, your money compounds incredibly fast. This is how the pros turn a single duplex into a massive portfolio.
All right, Section 3, the 4 C's of lending, or what we like to call your borrower's DNA. To actually fund all these real estate dreams, you really have to understand what lenders are looking for. First up is credit. And honestly, the biggest takeaway here is super simple. Pay on time, and whatever you do, don't max out your credit limit, also known as your utilization. Those 2 things alone make up almost 2/3 of your entire credit profile. It's not magic, it's just proving to the bank that you are consistently responsible. Keeping those balances low shows them you aren't desperate for cash.
Second, we have capital. Now, you can't just show up with a bag of cash you found under a mattress yesterday, right? The money you've saved needs to be officially seasoned in a bank account. Lenders want to see a verifiable history of those funds sitting securely for a specific timeline, usually at least 60 days. They just need to know the money is genuinely yours and not a quick, temporary loan from a buddy.
The third C is collateral, which banks typically evaluate as loan to value. But, and this is a real game changer, successful entrepreneurs redefine LTV as lifetime value. Instead of just looking at a single, isolated transaction, top-tier operators ask, am I building an infrastructure that supports lifelong partnerships? Shifting your mindset to prioritize long-term relationships over quick commissions will completely revolutionize how you run your daily operations.
The final C is capacity. This revolves entirely around your debt-to-income ratio, or DTI. It's all about keeping your existing financial obligations low while you scale up your earnings. Lenders essentially want to know, do you have the actual operational bandwidth to take on new debt without it completely crushing you?
Which brings us to Section 4, comparing strategic loan options. Armed with those 4 C's, let's explore the highly specific tools you can use to build this empire. Okay, if you're an investor, a DSCR loan, which stands for Debt Service Coverage Ratio, is absolutely incredible. It lets you use a property's potential rental income to service the debt, completely bypassing traditional personal income tax hurdles. Think about it. Smart business owners write off a ton of expenses. That's great for tax season, but it kills your personal net income on paper, making borrowing super hard. But with a DSCR loan, the bank just looks at the property itself. If the rent covers the mortgage, you qualify. Period.
Now, when we compare standard loan types, the FHA loan, backed by the Federal Housing Administration, offers massive accessibility. You only need a 580 minimum credit score, a tiny 3.5% down payment, and they allow a much higher 56% debt-to-income ratio. You can literally buy a fourplex, live in one unit, and rent out the other 3 using this exact loan. On the flip side, conventional loans are a bit stricter, usually wanting a 700-plus score and tighter margins, but they are fantastic for long-term holds with fewer insurance premiums.
But what if you're cash-rich and paper-poor? Well, private investor loans are a huge bypass route. They do require a hefty 20% down payment and 6 months of reserves, but here's the kicker. Those traditional 4 C's we just talked about, they basically go out the window. Because you're bringing so much cash to the table, the lender feels safe. It's perfect for retirees or high-net-worth folks who need funding fast without jumping through traditional hoops.
Finally, we hit Section 5, Scaling Operations with AI, the ultimate lever. Let's zoom back out to business infrastructure and look at the ultimate modern growth hack.
The contrast in the data here is absolutely incredible. By deploying 84 autonomous AI agents to handle calls, texts, and underwriting, closing times completely plummet. We are talking about taking an industry standard of 45 days down to just 19 days. It's wild. Complex financial files are being underwritten in less than 90 seconds.
And here is the real punchline. Implementing this level of technological leverage results in a verified $37,000 in monthly operational savings every single month. That comes purely from automating that gritty back-end work we discussed at the start. Just imagine the ripple effect. It slashes your overhead and completely frees up your human team to do what they do best, build relationships and drive the business forward.
So as we wrap up this explainer, I really want you to ask yourself, are your daily operations focused on a quick sale today, or are you actually building an empire based on lifetime value? Are you practicing your shot? Are you leveraging powerful tools like the 1031 exchange and AI to play the long game? The entire playbook is right here. So, how are you going to execute it?